What's going on, everybody? Welcome on into today's video, and we are talking about options. And no, we're not talking about buying calls, buying puts, betting on stocks to go up, betting on stocks to go down. We're actually talking about selling options and how I'm able to pull over $100 per week out of the market by selling option contracts in just one of my portfolios, and why I think this is a strategy that if you're not utilizing, you 100% need to be thinking about and even utilizing in your own portfolios, because it can be a really big needle mover, especially when it comes down to compounding. So in this video, we're going to cover what option selling is and why it's different, how it's different from just the traditional buying calls and puts and buying options, why you'd even want to sell options in the first place, who is this best for, because there's different styles and strategies for everyone. Then we'll get into my portfolio, the current portfolio that does pull about $100 plus or minus, give or take. There's been weeks where it's done over 200. There's been weeks where it's 50, and it really comes down to what's happening in the markets. We're going to cover that exact portfolio for you right here, and then some best practices. Now, this is not something to overlook. I really want you to stay to the end. Or honestly, if you want to skip over everything in the middle of the video and you don't care, skip towards the end, because there's actually going to be a lot of information there that's very useful. And there's some things that you could do by selling options that might look really cool, right now, or when you start jumping in, but are actually going to be some pretty big limiting factors to your growth and to your rate of compounding over time. So stay tuned to that, because that's actually very important. All right, so what is option selling and why is it different, or how is it different from the traditional style of options? We're going to use Robinhood as an example. I think this is going to be the best visualization for most people when it comes to understanding this video, because a lot of people are first off familiar with Robinhood, either have an account, or if you don't have an account, this is the easiest way to show you how this works without having to kind of look at like super crazy option chains. Like, this is the most simplified form of doing it. So we're going to look at Cisco. Now, I decided to pick Cisco here because, to be honest, like, it's not like your traditional Apple, your Amazon, your Tesla, like everyone's going to do. So Cisco is our stock of choice for this example. We'll go to my portfolio here at the end, so stay tuned for that. And by no means are we saying buy this stock or any of the stocks that I have, because I ultimately have different averages, and the stock could be completely, different in terms of your approach to this stock over the next 6 weeks, 6 months, or 6 years, or even longer, right? Depending upon your time horizons. But let's use it as an example. So inside of a stock or wherever, you go to the option chain. So you go to trade Cisco options, and you pull this up and you think to yourself, all right, so I'm going to pull up Cisco options. Traditionally, what do? Oh, I think Cisco's going to go up, or I think it's going to pull back. So I'm going to go buy some calls, or I'm going to go buy some puts. But what we're going to do here is we're going to actually be on the other side of the trade, and we're going to be the one selling the options to the person like ourselves who maybe in the past only bought options. So when you buy, there's someone selling. So you're just taking the other side of that trade. Now, how do you do that? Because there are some limitations there. Well, first off, if you want to sell somebody a call, you want to sell somebody the right to buy 100 shares of a stock at a specified strike price, that's like what you're doing. You need to actually own 100 shares of that stock. So it's called selling covered calls. Why are you covered? Because you have the 100 shares. So if that call ends up expiring in the money, they will take your shares and essentially sell those shares at the strike price that you sold that call for. And if you guys want more in-depth videos going forward of specifically breaking down selling covered calls, like every step of the way, everything you need to know, I can totally do specified videos on covered calls, selling puts, all this stuff. But for the most part, for most people, like, this breakdown should be a really good starting point for you. Not to mention the comment sections are always open for either my responses or to get questions and things answered by other people from the community around us right here. So Cisco, let's say I buy Cisco. I got 100 shares of Cisco. Great. Now I can sell covered calls against my position. Now, why would you do that? And realistically, how does that work? Well, give us 1 second here. Let's talk about puts first. If I was to go ahead and sell a put, how does that work? Okay, selling a call, I just said, you have to have 100 shares to sell one call. Let's say you got 1,000 shares. You can sell up to 10 calls against your position, right? So it could be a way of cash flow, and I'll show you what I mean in just 1 second. And hopefully this picture becomes very, very clear for those who are kind of still asking those questions of like, okay, why would I do this? Like, how does this all work? Now, when it comes to puts, selling a put is actually really cool, because What happens when you sell a put, it's almost like setting a limit buy, but getting paid to do it. That's how I view selling puts. And what a lot of traders will do, and some traders will actually do this, is that when we see super big capitulation moves to the downside, big time red weeks, they'll go out hunting for some of the stocks to take the biggest hits that they believe can rebound, and they'll go sell puts. And why is that interesting? It's because when you sell the puts on a really red day, when things are super nasty in the market, you're actually going to get a really nice premium because a lot of people are FOMOing into buying puts, just buying puts, thinking that we're going to keep going down, 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 down. So the open interest, right, the volatility, like there is just so much volume flooding into these things. And so the premiums tend to be a little bit more juicy, as I like to say. And so you can go ahead and sell a put. And hey, if the stock ends up finishing the week or by the expiration date below the strike price of the put that you sold, well, yeah, you got paid to sell the put, but you're going to now have to buy 100 shares per put that you sold at that strike price. Okay, so for example, right here, September 9th, in this example, when I'm doing the video, if I sell a $45 put for Cisco right here, it's currently above 45, but I can go ahead and sell this right now and get paid 31 cents per contract or per put that I sell. So that's $31 in my account in option terms, because you're going to have to multiply that number by 100 to get the actual price that someone's going to have to pay or that you're going to be able to sell. But you also need to make sure that, okay, yeah, you can get paid $31 for that. Cool. And if Cisco finishes above 45, guess what? It doesn't get filled. You don't have to buy the stock, and you just got paid 31 bucks and the stock's a higher, and who cares, right? That's what's really cool about it. But you need to make sure you have $45 per share of Cisco times 100 shares if the stock was to finish under the strike price that you sold a put for, okay? So just how on the selling call side, you need to have 100 shares of the stock yourself that you could essentially give away at that strike price if the stock finishes above the strike price by the expiration or the option finishes in the money, as we say. In the same situation here, if the put finishes or expires in the money, you need to be able to buy the shares. Or you could, of course, buy back your option for a higher price so that you don't need to actually buy the shares. But realistically, for me, I always sell it. I always sell puts at prices for stocks that I want to buy anyway. And if I get filled, great. If not, I still got paid to do so. So I still made something out of the trade anyway. So that's kind of how it works, and that's how it's different. Now, why would I sell these things? Well, I think it's pretty straightforward. It's cash flow, right? It's just cash flow. It's a way to get paid and to actually squeak out slightly higher percent returns. Because, hey, if I look at Cisco and say to myself, you know what, Cisco, I think you're a buy at 45. Well, then why not set a price or set that 45 to be my limit price? Instead of putting a buy right now at 45.10, I could essentially say, I'm going to go sell a put, get paid 30 bucks to buy it at 45. And if it finishes the week under 45, great, I'm in. And I got paid to do so. And now my average is actually, technically speaking, just below 45 because I did get paid to enter that position. So it's a way to kind of bring down your cost basis on trying to get in, and when you're selling puts, to get in and buy stocks. And when you're selling covered calls, it's seen as almost setting a limit price for a sell. If a stock has gone up and appreciated way more than you really believe it's worth, it's a great way to start taking profits and getting paid to do so as well. So before we get into the portfolio, who is this for? Okay, when it comes down to it, selling options is for somebody who wants to see more cash flow in their portfolio, who wants to compound a portfolio at a higher rate than what maybe they would be doing if they're just buying and holding stocks as investments. But it's also for someone who is willing to sell their stocks or who is willing to be a little bit more active in their investing. This is what I think the best way to kind of bridge the gap from being someone who's a long-term investor to more of an active investor before getting to being like, a swing trader or even a day trader, right? There's steps, there's levels here, right? And the risk, obviously, as we move through being more active, it becomes a lot higher. The reward is certainly there, but the percentage of people who can be profitable or who are going to actually benefit from being more active starts to diminish the more active you get in your trading and investing. That's just simply the stats that we have in front of us, right? So now with that out of the way, let's dive into the current portfolio and what's it doing today. Today, it's actually up a good bit. It's up about 7% as we speak. Partially, or some of that is because of options that I have sold, and some of that is just, or a lot of that is just because of the stock's appreciation that we've been seeing today. So here's the deal. When it comes down to a portfolio that's around $10,000 in value, what we need to understand is that, hey, I'm owning stocks in this portfolio and I'm also in on some margin as well. So that's part of this. So it's not like I'm only in with 10K. It's a little bit over in terms of margin, but I'm not too worried as I'm going to be getting out of some positions that I'm in because some have appreciated a good bit, which we can even talk about too. And one of those is KOLD. I've sold a nice call. It's going to be about a 20%, 25%, maybe 30% play. And it was something that I just bought the shares and sold a covered call. And that covered call essentially, it looks like, at least as of right now, I should get taken out in the future or at the strike price that I've set, which would be about a 30% gain net on that position that I've only held for a couple of weeks, which is pretty cool. But the majority of the gains that I'm going to see is by picking stocks, holding stocks, and investing in this portfolio over the long term, right? That's the majority of the moves and the gains that I'm going to see in this portfolio, okay? However, the icing on the cake is the option selling. And as you grow a portfolio, this is what I love to talk about. This is the beach portfolio, as we like to say here. We've mentioned it on some live streams in the past. What I mean by that is this is the type of portfolio that you can ultimately run from your phone on the beach. You don't have to be here sitting there watching support resistance, sweating it out, sweaty palms, freaking out, banging on the desk, throwing keyboards, breaking computers, right? Because you're getting things wrong. No, you don't have to do any of that crap, okay? This is a portfolio that you could sit back and say, hey, this stock has now exceeded my valuation, at least in the short term. And I bought, let's say, Snapchat at $9 and Snapchat's now at $11, and it only happened in a couple of days or a couple of weeks. That may be too much too fast, and I might be looking to take some profits on Snapchat so I can go and sell a covered call at 12, and if Snapchat hits 12 by the end of next week or this week or whatever strike price expiration date that I pick, take me out, and I'll lock my gains in because it made a big enough move, and it's made a pretty big move off of where it was, and that's a good enough move for me right now. But the majority of the gains are going to come from ultimately picking your spots and making money off your actual investments, right? Not just because you're selling options. This is the icing on the cake. And it can be that cash flow that we talk about too, that could ultimately compound the portfolio faster or pay you faster. So if you're pulling $100 a week, do the math, guys. It's $400 a month. Like on average, I think realistically, this portfolio probably pulls closer to $500 per month, roughly as we speak right now. Every week and every month is going to be slightly different because there are situations where maybe it's better to sell puts, maybe it's better to sell calls, covered calls, or maybe there's a week where we don't really do too much and not much happens and you don't do anything and you only sell, an option or two and you make 30, 40, $50 in this portfolio, right? So you don't make too much, but that could pay for a couple lunches. It could pay for this. It could pay for that if you pull the money out. And it's useful to cash flow that money. So if we look right now and take a peek at what we've done here, we have our positions, underneath here. We got a bunch of stocks. Some of these stocks I'll be getting, taken out sooner rather than later. One of these examples is Upstart. If I pull this up, here's my Upstart position. So this is a great example of a stock. So I bought 100 shares of Upstart at the end of last week. Now, in the way I did so, I actually ended up, if I was to find the history on this stock, which is kind of funny, I ended up selling a put back on August 26th at a strike price of $24.50, okay? And in doing so, I got paid $1.08. So I got paid $108, right, down here to do this. And then what happened was Upstart finished that week right underneath $24.50, which meant that I got filled. I had to buy 100 shares of Upstart at $24.50. So I did. Now the next week, guess what? Upstart's bouncing. We're getting a green week. Okay. What's happening? Well, what I decided to do is just yesterday, actually, is I sold a contract right here, a covered call at a strike price of $28 for Upstart. Okay. So I sold the 28 strike Upstart calls for this week expiration. And I got paid $18. Nothing crazy. If I went out an extra week, I could have got paid a lot more. Nothing crazy here. But guess what? That's $18 in my pocket. And hey, if Upstart finishes this week over $28, guys, that's roughly a $4 move on this stock in a week. Like that's a lot. That right there to me is, hey, if that happens, I will take the gains and happily wait for it to come back down or find something else or just sit on those gains for now and wait for a better opportunity elsewhere in the future. So that is the power, and that's what I'm doing in this portfolio. That's a great example. Now, I sold this for 18. Looking back, that was yesterday, right? Now, did I see Upstart having a 7% day today? Not necessarily. This contract that I sold for 18 is currently going for 23 cents now. Now, as we get closer to Friday, the expiration date, if it doesn't get closer and closer to 28 bucks, this is going to bleed off and eventually, ideally, in my best case scenario, expire worthless while Upstart finishes with a nice green week, meaning that I can come back in next week and sell a covered call all over again on Upstart. So that's a great example of how this works. On top of that, I'm also selling puts. So Palantir is down towards the lows. So Palantir right now, as we speak, currently sits at $7.23. I said, hey, you know what, Palantir? I'll buy you. I'll buy you at $7. So what did I do? Well, I sold a put. And if Palantir finishes under $7 this week by Friday, I'll buy 100 shares of Palantir at $7 and I'll sell covered calls against that position. I sold this, got paid $7 or $6 for it. It currently goes for 8 cents. We'll see how it goes and we'll see where this shapes up by the end of the week. But I got paid $6. So you see $18, $6. And of course, there's more out there. There's more positions that I have. And if I look a little bit deeper, here's a Soxl position, SOXL. If I scroll down and find this, I got paid 10 cents there. So you see $10 here, almost $20 here, $5 here. It all starts to add up. Now, in terms of best practices, here's what I want to make sure you are aware of and understand when it comes down to it at the end of the day. Okay? Here's where you run into trouble. Okay? If you are, let's say, someone who is a long-term investor and you think that, let's say, Upstart is super undervalued and you think Upstart realistically should be a $50 stock. I'll go to Upstart really quick, right? What you could run into trouble is if you do this and let's say you sell a covered call because it had nice premium and you sold a covered call that looked good and you're like, you know what, I'm going to do this. But now it hits that target and you get taken out and you're like, shoot, man, I got taken out. You could definitely limit your upside. So this is where there are people run into problems, okay? You could totally cap your gains well below what you could see in the long run by just buying, dollar cost averaging into undervalued investments and holding and not selling, right? For stocks that you believe in long term. However, this strategy, I think, can be very, very useful for someone who is happy to look at the stocks and see opportunities in the markets and see, or have a bigger picture macro view, or even someone who's like a swing trader, right? Who sees opportunity and is not afraid to take that sell before the long-term capital gains kind of classification, hits after a year, right? That is what you need to make sure you're okay with before you kind of dive deeper into this stuff. So when it comes down to it, don't be randomly selling covered calls and puts willy-nilly. Make sure you have some sort of plan. And if, Upstart at 28 is overvalued to me, then great, let me get taken out. In my situation, I don't necessarily care if it's overvalued, undervalued. That's a big enough move in a short enough period of time. I'd be happy with those gains. I'll take that to the bank and I'm happy. Like that's the way that I approach that. I don't approach that with, oh man, I'm pissed that I got taken out. I would be happy to get taken out at 28. And if it happens, it happens. So make sure you understand what strike prices you're selling covered calls at. And for most people who have that much longer term view, this is great. Just make sure you're selling calls way out of the money or even selling puts way out of the money. And you're not going to get paid as much for those positions or for those options, at least in the short term. But what could be useful is that it could be an added dividend or it could be a couple extra bucks of cash flow that you wouldn't have had otherwise. And you put yourself at a pretty low risk of actually having those options expire in the money, having to buy the shares or having to give your shares away at those prices. That would be some of the best practices that ultimately comes down to your style and strategy and what your end goal is. But for me, if this portfolio did something like 25% per year compounded, that is amazing. I will be so happy with that. And so that's why I'm fine taking 20, 30% gains in the very short period of time, because that right there is killer by itself. So there you guys have it. Hopefully this video makes some sense. Hopefully you got something out of it. If you did, make sure to hit the thumbs up button and consider subscribing to the channel down below. Again, if you have any questions or you want me to dive deeper strictly into covered calls, selling puts, completely step-by-step unpacking it all, I'd be happy to do videos like that in the future. And make sure you check out some of the live streams that we do here on the channel all the time, selling covered calls live, trading stocks live, all that good stuff, as well as our other videos and playlists here on the channel that should provide you a ton of information for free without having to pay for these crazy courses and stuff that are going to promise you and sell you a dream at the end of the day, when in reality, it's the skills, it's ultimately you that is going to make the difference in your own trading and investing. Thanks so much, guys, and I'll see you in the next one. Peace.